Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Welcome, listeners, to the 117th episode of the Independent Advisors Podcast, where Mark McEvely and I, Matt Jessup, bring you everything you need to know from the past week in the world of financial markets and financial planning. This week, listeners, we are blessed to have Nick Whitaker, our firm's Director of Research and Trading, a part of the podcast. Nick, welcome.
Thank you. Pleased to be here.
You excited?
I am, very much so.
It's going to be a fun one.
It's
going to be a fun one. So, listeners, but before we begin, as always, Nick, would you like to discuss a recap of performance?
Yeah, let me jump in here as we always do. So this data is from COIFIN. So the S&P 500 index on the month was down 4.8%, so a tough September for us. On the year, still up 14.7%. The Dow Jones Industrial Average on the month, down 4.3%. On the year to date, up 10.6%. The NASDAQ on the month down 4.9%, on the year up 12.6%. The IWM ETF, that's the Russell 2000, or ETF that tracks the Russell 2000, down 3.2% on the month and up 11.6% year to date. The Vanguard International ETF, excluding the US, is down 3.9% on the month and up 4.5% year to date. And switching to Treasury yields, the 3-month T-bill is sitting at 0.04%. The 2-year Treasury yield is sitting at 0.28%. And the 10-year Treasury yield is currently sitting at 1.49%. And all of this is as of the close on 9/30. So, a tough September, but things are still positive year to date. So that's kind of where we are in the pricing.
Yeah, a couple things that kind of jump out at me, Nick, as you were going over those numbers. One, international. So we were double digits for the year a couple of months ago. Now we're up 4.5% for the year.
Yep. Another
kind of viewpoint is we had some dramatic outperformance earlier in the year by the S&P and the Dow compared to the NASDAQ. And you're really starting to see that performance narrow. The outperformance that they both experienced above the NASDAQ has really narrowed.
Yeah, big time.
And that's just a couple of viewpoints, listeners, that kind of jump out at me. Now let's transition, Nick, to big headlines and current events for the week. I'll start off with a couple, then I'll transition to you, sir.
Alrighty.
After 22 consecutive weeks, listeners, of increases in the Drewry's World Container Index, the composite stopped rising last week. And we mentioned that crazy prices to ship containers from China in recent podcast. And this is from the Director of Research at Hedgeye. I just throw that out there, Nick, because I think that's a respite that's very much needed, because the higher shipping cost translates directly to higher prices.
Yep.
Right? The other thing that caught my eye is Janet Yellen apparently came out with a stance on unrealized capital gains. And from what I read, she said that unrealized capital gains is income. And I hope I'm not taking this out of context, but that's just a little weird in my opinion. You have any comments?
It's a bit of an odd take, I suppose, but there's been a lot of headlines out of Washington over the past month. So yeah, we'll see where all of this goes by the end of the year.
Yeah, I don't think it's going to gain traction. And listeners, what Janet Yellen is discussing is usually one does not pay taxes until you actually sell and realize, say, the gain. So if you bought a stock for $10, XYZ stock, it goes to $12. You sell it, you have a $2 per share gain. You realize it, you get your proceeds.
Yeah.
They're insinuating that at the end of the year, even if you still held the stock, that you'd have to realize a $2 gain. I don't see it becoming actual tax law, my 2 cents.
Yeah, it seems unlikely given the history of what it has always been.
Right? It would be like saying to somebody, well, in my opinion, my analogy is, well, just because you attempted murder means you murdered them and you get the death sentence.
Right. Yeah.
That's pretty
morbid.
I'm sorry to go down that road.
But yeah.
Extreme example, but
It's not cash in your pocket, so yeah. I'm
it
with
just says
you
it's
where-
just
yeah.
it's not relatable. What headlines caught your eye this week, Nick?
So one of the things I wanted to do, because there's been so many headlines in this week and the past 2-3 weeks, really, is just do a recap on what's going on in China for listeners. And I wanted to do this because it's something that, I wish the news cycle did a better job of just summarizing the big picture, because there's a lot of major headlines out there, from Evergrand to the manufacturing, the supply chain, and the energy crunch.
They haven't done a
So-
good job, so I'm looking forward to this.
Yeah, so and hopefully this is helpful for listeners. So I'm gonna kind of blow through these points, and there's a lot to unpack in here. So I'm gonna start with Evergrand, and I'm gonna tell listeners ahead of time I've picked up all of this information from Bloomberg, Financial Times, and Goldman Sachs.
Okay.
So, let's start with Evergrand. What is Evergrand? They're a massive real estate developer in mainland China. But the important thing here is that they are in a lot of different parts of the Chinese economy. They have investments in anything from electric vehicles, theme parks, soccer team, food company. They have individual wealth management products.
Is it kind of like a General Electric kind of sounds like a GE, like they got there's in almost all these different industries.
So that's a great question. They're primarily going to be a real estate developer, right?
That's the primary part of their business.
Right. But the big concern is their hand is in so many cookie jars, so to speak, that they're very large and important in the Chinese economy.
Got it.
So I have a couple stats here that just help put this in perspective. Evergrande is estimated to be equivalent to 2% of China's GDP.
Just on its own.
Just on its own. So very, very large company, right? And the company's land reserves alone are large enough to house 10 million people.
Just the reserves.
Just the reserves. So, they have tons of residential, tons of commercial, tons of real estate development properties. So what started the issue? Why are they in the mainstream? The issue started with using massive amounts of debt to grow the company. And it's gotten to a point where they have a bit of a liquidity crunch. And a couple weeks ago, they reached out to the Chinese government and said, hey, we need help because we don't have cash to pay back our debts. And so you get a lot of, the mainstream media starts to find those links of, Lehman Brothers. So you'll read that out there. And it's just because it's such a massive company that's having liquidity issues that, we're now very well aware of.
For some of our younger listeners, can you explain Lehman Brothers, like what happened?
Yeah, absolutely. So that goes back to the Great Financial Crisis, 2008, and Lehman Brothers was the massive bank that really started the tumble, right?
The U.S. government did not bail them out.
Exactly.
They let them fail.
Exactly. And so that's where this kind of comparison comes. And it's not really a like-for-like comparison because Lehman Brothers was in a different business than
Of course.
Evergrande, but that's why you get the comparison.
And people are trying to draw an analogy.
Exactly.
Got it.
And it helps provide scope. But, it's not apples and apples there, just for listeners.
I would agree.
So why is it a big deal? The big deal is just similar to what we were just talking about with the Lehman Brothers. It's so big, and Evergrande's hand is, like I said earlier, in so many cookie jars that you could have a bit of a snowball effect if they were to default on their debt. And then more debt's going to, they're going to be required to pay more of their debt sooner, and it just continues to snowball and adversely impact their economy. And it's already putting pressure on the housing market. If they were to default, it would put even more pressure on the China housing market,
Which is a big part of their economy.
which is a massive part of their economy. And what would happen is they would basically have to fire sale a lot of their properties. And 2% of the GDP that I mentioned earlier, think of a large part of that as property. So think about all that supply flooding the Chinese housing market.
And think about how important home prices are in values to the American consumer. That translates over there.
Exactly. And
Okay.
so that's where the concern is in the news, and that's why you're seeing it all over the news cycle. And it's just that snowball effect and what will happen. So where are we now? Evergrande has missed some coupon payments, and they're raising money and selling assets in order to pay debt, in order to prevent their default. They've sold some of their state-owned bank shares, and they've actually reached out to state-owned enterprises to purchase some of their assets. And then at the same time, the China government has come out and talked to 24 different banks and asked them to support the property markets. So that's kind of where we are. We still don't know how this is going to play out. We don't know if it's going to be like a major bailout or anything, but, just kind of a wait and see right now. But
it feels the beginning of a bailout for me. I know that they were posturing that they weren't. Mm-hmm. It feels like they are, because when that came out about them having to ask state-owned enterprises to purchase some of their assets, I think that was definitely blessed by the government.
Yeah, absolutely. And I think even more so China coming out and talking to those banks and saying, hey, we need to support the property markets. I mean, I think
they understand the systematic risk to their own country.
Exactly. So we'll see what happens. You're going to read plenty of things out there, and I've seen opinion articles just in the past week about how China's not going to bail them out. But, it's all, we don't know, right? We'll see what happens.
Yes.
So that's where we are on Evergrand. So I want to keep moving along because I've got two more China topics to cover.
Please.
One is on Wednesday, the Chinese Purchasing Manufacturing Index, that's PMI. That number came in at 49.6. It's an economic data point. And for listeners who aren't familiar with that, it's an index, and any reading above 50 signals expansion.
Yep.
Any reading below 50 signals contraction.
So to see a contraction in China is very rare.
It is. And I think more important, that 49.6 is close to 50, right? So we're technically in contraction at this point. But what's more important is the trend here, and why I'm bringing it up is because it's been steadily going lower since about May, June.
Okay.
And I'm not raising red alarms or anything, but it's just another piece of the story. It's something else that's going on in China that's being talked about. So I want to bring that up. So the big question is, okay, why? Why did they enter in contraction in this latest month? And the biggest answer to that question is the energy crunch, which has also been in the news a lot.
It has.
And another piece of it is China provinces trying to meet energy efficiency targets. Now, that's not being talked about as much, but I think there is a little bit of that going on with provinces trying to cut back and meet these targets that they've set for themselves. But more importantly, in my mind, is the energy crunch, which I'm sure people have read about. So my last point on China is this energy problem. So what's going on there, right? Half of China's mainland provinces are limiting electricity use. Why is that happening? Mainly because of high coal prices and just high demand for energy, right? These high coal prices have actually caused some power generators to shut down in the country. So, the cost of energy and the demand of energy has gotten so out of whack that some of these factories, these big manufacturing plants and whatnot, they've had to shut down because the cost benefit is just not there, or they don't have the energy or whatnot. So some of them are shutting down. Some of them have, scaled back their production to maybe only 2-3 days a week. And some managers that have been interviewed have even turned down orders from overseas, which is a pretty big deal. But to me and everything that I'm reading, a lot of this gets down to just the supply and demand dynamics, which are a little bit out of whack right now, just way more demand than supply that's out there.
Which started because of COVID.
And we'll kind of get into some of these balances, or imbalances, I should say, in the economy a little bit later in the podcast as well. But it's just going to be interesting to hear how this unfolds. So that was kind of a lot on the headline side of things for listeners, but I wanted to just provide that, big picture, what's going on in China. So you've got Evergrand, you've got the manufacturing sector that's struggling, and in large part because of an energy crunch, because the supply demand dynamics are so out of whack over there. So I think that's a pretty good summary.
That's a great summary, Nick. And the one thing that is concerning from my perspective is if these manufacturers are unable to produce widgets, or you name the product, it's not available to be shipped worldwide to the end consumers who want it. So that's why another reason you're seeing higher prices for goods here in the U.S. And I use the term widget because it can be anything from a TV to a refrigerator to a phone to you name it. And if the supply is less and the demand is there, what happens to prices?
To a part for a car.
Part for a car. Yep. I mean, if Mark were here right now, I know he would be talking about his shower. The guy just moved to a new house, can't use his shower till January because of a microchip.
Yep.
Right? So I think this is good. It helps listeners give perspective. And how you make this relatable is obviously this is affecting stock prices right now.
Absolutely.
And this is a reason why you've had softness here in September.
Yes.
As the market is trying to disseminate how long will this last? How will it affect corporate earnings?
Yes.
Really, and I think that's what's happening. Would you agree?
Absolutely. So that's where, September has been weak. We talked about the numbers in the beginning of the podcast, down, let's call it 4.5%. A lot of that has to do with these big macroeconomic risks. A lot of these headlines coming out of China, a lot of the headlines about the supply chain. How will these bottlenecks play out? Is it going to be pushed further out into 2022 or when the supply chain kind of gets corrected and whatnot? And how much will that impact earnings in the short term?
Yeah, and then I'll just throw it out there. I mean, the market lately tends to shoot first and ask questions later.
Exactly.
And so just remember, just because the market corrected doesn't mean the market's right on this.
Absolutely.
And you could see it's the possibility of a V-shaped snapback is definitely there.
Yeah, and that's what I think is so interesting, and one of the things that I'll want to ask listeners to just take a deep breath on and think about as you have a little bit of a pullback in the market and all these headlines out there. But what do we know that has changed since the last quarter's earnings? We haven't heard a lot of these CEOs come out and talk to us about this. So that's what I'm ready to hear, is just, directly from the sources that really know what's going on. So that'll be interesting to see with this upcoming earnings cycle.
And what Nick is talking about there further is we just ended Q3. And so the earnings for the third quarter, listeners, will come out generally at the end of this month in about 3 or 4 weeks.
Yep.
And what gives me a little bit of comfort, Nick, and I would like to see your feedback here, I'm not seeing an absorbent amount of warnings. There's some out there, but not as many warnings, and that would be from, say, the C-suite of these companies coming out and saying, we're definitely going to miss earnings. We want you to know. I'm not seeing a ton of that.
Yep.
That gives me a little bit of comfort. And
Yeah,
I feel like the market is ignoring that. My 2 cents.
I think partly the market's ignoring it because, the performance has been relatively strong. I mean, we're still up year to date.
Yep.
12, 13%.
Sure.
So, sell now, ask questions later.
Yeah.
Maybe.
And also, I think it feels worse because we haven't had a 5% pullback in some time.
Right.
We talked about this in the podcast. I guess tongue-in-cheek, 5% in this lower volatility environment over the past, 9, 12 months feels like 10 or 12%.
Yeah, it does.
Just feels that way.
Yeah. There's just a bit of angst. I think people are looking for a reason to sell.
Yeah.
Because the stock market has done well, and the V-shaped correction that we've seen since COVID, has people questioning, do we need another correction?
And this is where, if Mark was here, I'd joke with him, where else is she going to put the money? Money's going to come right back in my opinion. Where else is she going to put it to get a return?
Yeah, exactly. Yeah.
Well, all right, so let's transition. Let's talk about tweets, articles, and research from the week. Nick, I'm going to let you continue, buddy. You kick it off.
Alrighty, so I've got a couple here. The first one is another update on housing for everyone. So this is a tweet from the Director of Research at Hedgeye. And it's a tweet about housing inventories. U.S. housing inventory is at a 2.6 months, which remains in the bottom decline of the trailing 20 years.
That's very low inventory, Nick.
It is very low. So what does this mean for listeners? It means the housing market is still tight. That there's not a ton of supply in the market, and it's actually record lows, particularly relative to the balance. They have a balanced line here in this chart. If you guys want to look at it at home, and you can really see how low it is. So that's the first one I have. Do you have any thoughts on that one?
My initial thoughts is, we've had, listeners, a little bit of an uptick in mortgage rates over the past month. And despite that, because in my opinion of tight supply, it's continuing to support these higher prices.
Yep.
My 2 cents. And listeners, you can always obtain our show notes by visiting our social media sites. And the best link I always like to say is if you go to our homepage, jessupwealthmanagement.com, you pan to the bottom, you're going to see the links for our Facebook, LinkedIn, Twitter, Instagram. All of our links will be there at the bottom, and you can access these show notes, and you can see this exact chart that Mr. Whitaker was referencing. What else you got, Nick?
All right. The other one I have is an update on CapEx, and it's more economic data. I love economic data.
Well, again, it builds a picture.
It does.
Right? It builds a picture.
So this is a tweet that comes from the executive director at Employ America, and it's a chart showing the manufacturer's new orders on non-defense capital goods, excluding aircrafts. So I want to just explain this data a little bit so that people understand really what it is. So the data measures the cost of orders received by manufacturers for capital goods. So that means goods planned goods planned to last 3 years or more, right?
Yep. This is microwaves, dishwashers, refrigerators, stuff like that.
Exactly. Another word that you'll see in economic data is durable goods. So this is a part of that big durable goods release, right?
Yep.
But it's the manufacturing new orders for non-defense capital goods, excluding aircrafts. Right?
I like this because this is the stuff that's more expensive.
Exactly.
You're not just going down to the Dollar Tree and buying this.
Exactly. And so it has a chart here, and I'm going to kind of talk to you about the chart. And the reason I like this chart is because it shows 20 years, so you can really see the trend.
Yes.
And you can see the impact of COVID in this chart, where you can see the numbers for new orders fall down to $60 billion monthly, $60 billion of new orders monthly in COVID. And now we're up to 77 billion. And you can really kind of see that V, and even more than just the V, not only have we recovered from where we were, we're well above it.
We've surpassed it.
We've surpassed it. So why does this matter? This is the kind of, and this ties very much into what we were talking about earlier on the supply chain and things going on with manufacturing in China. The reason this matters is because it gives us insight into the supply chain. It helps us understand what's going to happen with earnings in these industrial companies, machinery, technology, manufacturing, transportation. So to simplify it, a higher durable goods number indicates the economy is on the upswing, right? Now, when that happens, that's a good sign for corporate earnings, right? When you have more and more of these orders, that means there's more demand. Companies are feeling confident enough to order, right?
I mean, absolutely. And it all translates into earnings. And it also, in my opinion, talks about the high demand from the end user. Mm-hmm. And I've been saying on this podcast for many, many months now that the underlying quality of the American consumer is the strongest I've seen it in some time. And when I say quality, Nick, I'm talking about the personal balance sheet. Mm-hmm. I'm talking about their wages. I'm talking about the ability to spend. And the reason that's important for listeners is if you can be finding companies that are producing a product or service that is in demand and the accessibility to it, that company should be executing right now.
Yep.
Right?
Yeah, I'm loving that you're saying this because it leads right into my next.
Okay, I'm sorry.
Next tweet. No, this is perfect.
I didn't mean to steal your thunder.
No, this is perfect. It works perfectly. So my next tweet is a bit of a continuation on the supply chain issues.
Okay.
So it comes from Gregor Samsa, who's an independent economist and trader.
Okay.
And his comment says, the bulk of the problems in the global supply chain are caused by excess demand.
Boom.
Boom. Right. So this chart shows retail sales, and so he's talking about exactly what you're talking about, a strong consumer. And I really like this chart. Again, it gives historical context. It shows the past 20 years, or excuse me, the past 10 years. And I know the supply chain has been a hot topic, so that's why I have this in my notes so much.
Love it. Keep going.
So it shows the U.S. retail sales are up, and you can see the big drop in COVID, and you can see it surge, all the way to 600,000 here in this chart. And what I like about this chart is, and I urge listeners to check it out, is it shows a trend line. So it shows retail sales over the past 10 years, and it paints this trend line of where would we be if COVID didn't happen.
Yes.
Right. And you can see the massive shock to retail sales in COVID, and you can see how far past we have shot above that trend line. I mean, massively higher. And so, I think that just is a perfect point to elaborate on what you were just saying is, when you have these retail numbers and these strong consumers out there, along with the supply and demand dynamics of the energy markets, I mean, it all kind of makes sense why we have a supply chain issue, right?
Yes.
And so you look at this chart and it's kind of like, oh, of course we're going to have some issues. I mean, there's massive fluctuations in the economies, and there's no way to plan and be ready for volatility of your orders like at that level.
Yep.
You know what I mean?
Yep.
So yeah, that's the last one I have for you. You have any thoughts on that?
I do. So here's my other thought I want to throw out there for listeners. It's in regards, again, to the status of the American consumer. And I can't emphasize this enough, Nick. With 2/3 of our economy consumer spending led, that's a vital part of our economy. And when I look out, I foresee let's just say the quality or the spending capability of the American consumer, in my opinion, is not going anywhere anytime soon. With that being said, where you follow the tea leaves as an investor is you got to find those companies that have better supply chains than others that can source the products and that are selling the product and or have providing a service that are in demand. And generally speaking, I think those stocks should perform better than others if they meet those kind of qualifications. And, ultimately, again, 2/3 of our economy, consumer spending led, the balance sheet and the quality of the American consumer is strong, wages are going up. That is not bearish.
Exactly.
And I think with what you're seeing going on with seeing the reports of 50 plus container ships off the port of LA that need to get offloaded, this stuff will work its way through the system. Is it going to take multiple quarters? Probably so.
Absolutely, yeah.
But ultimately, the tailwind of the strength of the American consumer is huge, and I think not given enough credit as a positive when you look over the next 3, 4, 5, 6 quarters.
Right, which is those 3, 4, 5, 6 quarters is exactly what the news and the market is stressing about.
Yeah. And I think that the market right now is just so short-term focused. I mean, the market, again, I use the term shoot first, ask questions later.
Yeah.
I should rather say sell first and ask questions later. Ultimately, I think that this is what gives longer-term investors the edge. My opinion.
Absolutely.
Okay.
I agree with you.
So I got a couple I'd like to share with listeners. The first is I found a chart from David Schwell. And this is profitability levels of the S&P 500 index versus 2019. And he is the CIO of Family Management Corp. And the average investor is always shocked to hear just how much more profitable the S&P 500 is today, just versus 2019. So let me repeat that, Nick. Okay? Where earnings are today for the S&P 500 index to 2 years ago, I'm not talking stock price movement. I'm talking hard cash, okay? 36% higher. S&P 500 companies are 36% making that much more money in the last 2 years. Significant. Even Louie's excited about this data point.
Louis
Our office dog is pumped about the data point. That's just tremendous. And so when people then, sit there and say, well, these stock prices aren't supported by earnings, I don't know about that.
Yeah,
it's one data point that's, I think, pretty shocking.
That's a massive
gain in 2 years for the average stock on the S&P 500. Pretty crazy.
You compare that with all the inflation talk, and I mean, we're talking 4%. At different points in the year.
Lou, don't.
versus the 36. It's
okay. Well, listeners, my office dog, Louie, is causing a little bit of shenanigans here in the office. We apologize. For those watching on video, you can probably clearly see this. But I digress. Everyone loves Louis. So I got one more. Government shutdown talk, Nick. I know it's appearing to be averted until December now. The classic political kick the can another 2 months. So we talk about this at Thanksgiving. And you and I both know they targeted December, early December. So this would be the topic around the Thanksgiving table, right?
Oh, yeah.
Okay. So I want to provide some additional data to help potentially alleviate any anxiety that listeners might have in regards to the stock market. That's why I selected this.
I think this is great, yeah.
So this is a tweet by Carl Cantanilla. He is a journalist for CNBC. He's on TV usually in the mornings. He had a tweet that showed a chart from Goldman Sachs Investment Research that goes back to the last 14 shutdowns since 1980. And the median return of the S&P 500 was down 10 basis points on the dates of the budget authority expiration and up 10 basis points during the shutdown periods and up 30 basis points on dates of resolution. You know what that says to me? Big nothing burger for the market, right? You mean, so I just want to throw that out there for listeners that I know Mark and I have made that kind of comment before. I got raw data behind it. I'm not just picking it out of thin air.
Yeah, it's always a lot of talk. I had conversations with friends in the industry about this, last week, and we both said the same thing where we're talking about it, and it's just a lot of talk. And it's something for journalists and for the news to write about and latch onto, but ends up being
doesn't
a lot
really
of
affect
nothing.
The stock market.
It doesn't
when you look at history,
right? Because they normally find a way to kick the can down the road, and we all move on.
That's right.
Next topic.
Yeah, that's right.
Right.
So listeners, you're going to hear about the shutdown talk again, right around Thanksgiving.
Yep.
So the last piece I have has to do with market sentiment. Okay. Now there is a survey by the American, I want to get this right, the American Association of Individual Investors. I always call it AAII. So the American Association of Individual Investors does a weekly survey on sentiment. And you could only answer 3 ways. Nick, I almost said Mark, because I'm used to the podcast with Mark. It's either you're bullish, neutral, or you're bearish. There's only 3 options you can have. Okay? Now, this survey going back recently, this is the 8th time in 10 weeks that pessimism is above average. Pessimism in general, Nick, remains near the top of its historical range. Now, I like this data point. Why? I like low levels of bullishness. I think it's another data point that helps reset things in the market and can help provide that next leg higher. I say this because usually low levels of bullishness is accompanied by higher levels of cash on the sidelines. It takes fresh powder, i.e. new money, to push prices higher. So a couple minutes ago, you and I were talking about the selling that we saw in September. Money's on the sidelines. Interest rates are near still all-time lows. What are people going to do with the money? Honestly, what are you going to do with the money?
Where is it going to go?
We're playing a game of chicken, listeners, in my opinion.
Yep.
Okay? And the game of chicken is this. Who is going to buy next? And when the rally starts, they're going to try to catch it. And that's a dangerous game of musical chairs that I don't want to be involved with.
Yeah.
That's my 2 cents. And this sentiment survey, in my opinion, kind of backs that up.
Yeah, I think that's a great way to end this section, because it summarizes a lot of what we've talked about.
It does.
Where you have all these risks, you have all these, this angst in the news and in the markets, and the market's coming down, and you have the pessimism from, that you're referencing here, and it's, we haven't even heard from the companies yet.
No.
From we haven't heard about it.
No.
So it seems a bit self-first. It seems just a bit premature for the markets to be hitting the panic button, right?
This could be an earnings season, Nick, where You might not buy the rumor and sell the news, meaning you might not see stocks rally into earnings, but you might have some major reactions after the earnings release the next day.
Yeah, that wouldn't surprise me.
Yeah. All right, Nick, well, let's transition for our listeners to the financial planning topic of the week. I selected this topic because of your recommendation. So listeners, Nick recommended that we cover the topic of required minimum distributions. And this will take me about roughly 2.5, 3 minutes to kind of go over. It's not going to be a long topic today. But as we get near the end of the year, a lot of clients who are required to take a withdrawal from their retirement account, this tends to be a hotter topic. So let's explain what is an RMD. Okay, so I'll start off. A RMD, or required minimum distribution, listeners, is an IRS mandated amount of money that you must withdraw from a traditional IRA or an employer-sponsored retirement account each year. It's important to understand when you need to take an RMD, how to avoid costly penalties for late distributions, and maximize your withdrawal strategy. So, Nick, age requirement. The IRS requires you to start taking these withdrawals, these RMDs, at age 72. Okay? Next topic, RMD amounts. If you are the original account owner, your RMD is calculated by dividing the prior year-end account balance by a life expectancy factor in the IRS Uniform Lifetime Table. In essence, in plain English, the government provides a mortality table based upon your gender and date of birth and says how long you're going to live based upon the mortality table, and that's divided by your prior year-end account value, okay? Now, there's some other things. However, if you're married and your spouse is the only primary beneficiary and is more than 10 years younger than you, your RMD is calculated by using a different mortality table. This one's called the IRS Joint Life Expectancy Table. And if your spouse is no more 10 years younger, your RMD is calculated using the IRS Uniform Lifetime Table. So not to get too much in the weeds, whoever your custodian is, whoever holds your retirement account, they're going to know based upon your date of birth, your gender, the primary beneficiary's relationship, gender, and date of birth. They're going to know what table to use, and they'll be able to tell you how much you got to take at a minimum.
Yep.
Make sense?
Absolutely.
Next, let's talk about account types. What does this cover, Nick? So RMDs must be taken out of tax-deferred retirement accounts. That includes traditional IRAs, rollover IRAs, simple IRAs, SEP IRAs, most 401k and 403b plans. There are no RMDs for Roth IRAs, Nick, unless they're inherited. Okay? What are the deadlines? April 1st. Deadline for your first RMD in the year after you turn 72. You do not have to take the RMD from your workplace plan until you terminate or retire. December 31, the deadline for each following RMD. Please note, Nick, that if you delay your first RMD until April, you have to take 2 RMDs your first year. The first will have to be taken by April 1st for the year you turn 72, and the second has to be done by the December 31st for the second year, or the year that you're, in essence, 73. Let's talk about penalties. Don't miss your RMD deadline, because regardless of your account type, the IRS penalty is very severe, Nick. 50% of the amount not taken. Now, I have a little trick. I'm not a CPA. I'm not a lawyer. But I do know that if there was an extenuating circumstance that made you miss it, you can write a letter to the IRS, and I've heard they're very understanding. I think sometimes the IRS gets a bum rap, because every time I've had a client that had an issue and they write a letter, they seem to be pretty good to work with. So I think
they're the tax man. Yeah.
I know. I think they just,
of course they're going to get a bad rap.
I think they get a bad rap. I mean, in the realm of understanding when legit situations come up. So I want to give them a little bit of credit there. Okay.
So I do want to emphasize, though, that the penalties on that's why we're bringing this up now. That's why it's a good topic, because we're getting closer to that deadline.
Exactly.
And, we've had some talk in the office about,
Yeah, this is a hot topic right now. I love this. Last thing I have is taxes. The IRS taxes these withdrawals as ordinary income. This is a biggie, Nick. This means that withdrawals will count towards your total taxable income for the year, and they will be taxed at your applicable individual federal income tax rate and also could be subject to state and local taxes. If you made after-tax contributions to your IRA, such as a traditional IRA, you must calculate your RMD based upon the total balance. However, your taxable income may be reduced proportionally for those after-tax contributions. I won't get that too much in the weeds on that one. Keep in mind that this income increase may push you into a higher tax bracket. It may impact the taxes you pay for Social Security and Medicare. I have had clients that have reached out, and as they've gotten older and their required minimum distributions have gotten higher, it has affected their Medicare copays because there is a component of that. And I remember several podcasts to go over the summer. I know Aaron was on once and he talked about that.
Yeah.
But before I transition from RMDs, anything else you want to add, Nick?
No, I think that's a timely topic. I'm glad you talked us through that.
Yeah. And I'll just throw it out there. We have our in-house paraplanner, Aaron Kramer, that if any of the listeners want to pick his brain, he's an RMD expert. And, you can reach out to Aaron and he can definitely help you out with that. Yeah. So as we sign off, before I do the official sign off, Nick, anything else you want to share with listeners?
I think we're good. I think we've covered it pretty well. Thanks for having me.
This has been fun.
It has.
I enjoyed having you as a guest this week. It's been a lot of fun preparing, doing the actual podcast.
Oh, yeah.
I love it. So listeners, thank you for listening to the 117th episode of the Independent Advisors Podcast. Nick and I hope you have a wonderful rest of your weekend and enjoy the beginning of the fourth quarter.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved. Advisory services offered through Commonwealth Financial Network, a registered investment advisor.